There's a point where having more personal credit actually starts to hurt you. Everyone's been told higher limits, more cards, more credit equals better. It does up to a point. After that point, you become invisible to the banks that actually matter for business funding, and that just results in denial. I'm gonna show you the exact range that gets you approved for the most and best 0% interest business credit cards, and why crossing it kills your approvals. I'm gonna teach you how to build a strong personal credit profile from scratch, and the moves to make once you hit the ceiling so you can keep stacking on the business side instead of stalling out. After coaching over 3,000 entrepreneurs over the last 5 years, we have seen the sweet spot of $40,000 to $80,000 in collective personal credit limits be the single most favorable range for business credit card approvals and the limits on the best cards. Not 200K of personal limits, not 300K of personal limits, and not even 100K of personal limits. Here's why this happens. When you apply for a business credit card, the bank pulls your personal credit report first. They want to see that you can responsibly handle the credit they're about to approve you on the business credit card. But they also want to see that you have room to take on more. If you already have over 100,000 or 200,000 of personal credit limits, even if the utilization is zero, the bank's model assumes the worst case. They imagine you maxing out all of your cards tomorrow. Suddenly, you look at $200,000 as a $200,000 risk, not $200,000 of opportunity. The approval comes back small, or for most comes back denied. At the range of $40,000 to $80,000 of personal collective credit limits, the model sees you as creditworthy, but not overextended. You're approved easier, and the limits come back much bigger. Banks know this. If you have too much personal credit, they don't want to lend you big business credit card limits. So what's the actual ceiling? Once a client crosses $100,000 in collective personal credit limits, then you start to become risky. Then you start to get the denials for too much personal credit. I've seen it 100 times probably. That's the line. It's 100,000 of personal credit. If you cross it, you're then going to get denied for business credit cards, specifically at some of the bigger banks. So when you get to that $100,000 ceiling, you have two options. Either you stack stopping personal credit cards, or you can manually reduce some of your limits. And at 100,000 of personal credit, it'd be a good time to pivot into business credit cards. But how do you actually get to that personal credit range of 40 to 80,000 if you're not there yet? You want to aim for at least 5 personal primary credit cards. Tier 1 is where you want to focus. Chase, Wells Fargo, Bank of America, and Citi. They're the highest tier. Then you can follow up with a couple tier 2s like American Express, US Bank, Capital One. But what you want to avoid is tier 3 credit cards. These are credit unions or retail store accounts. You want to avoid those and focus on tier 1. All they do is clog your profile and look like junk on your credit profile. The only exception is going to be PenFed, and in a second, we'll get to why PenFed is the only exception. For your utilization, it needs to stay under 10% on each account, not just all the time every day, but actually right before the statement closing date. You can max out the cards, the personal credit cards, you just need to pay the balance down a couple days before the statement closes, because on that statement closing date is when the bank reports that balance to the credit bureaus, and then it's stuck there for 30 days. A good thing about if your score is low due to utilization, you can just pay it down and your score can shoot up literally 100 points if you go from high utilization to low. When it comes to hard inquiries, you want to have no more than 2 hard inquiries in the last 6 months on each of the 3 bureaus. For your average account age, you want to have at least 2 years of average age. If you're over 5 years of average age, it puts you in a very strong spot. When it comes to opened accounts, you don't want to open more than 2 personal credit cards in a 6-month period. Okay, no more than 2 in the last 6 months. That's how you build a very attractive profile to the underwriters. So here's a strategy that most people just don't know. There's a thing called a pledge loan, and it can move your credit score 20 to 30 points. It moved me from an 800 to an 826 in about 30 days. So you deposit money, say for example, $10,000 into a savings account at a credit union. You take a loan against that deposit, then you immediately pay off 95% of that loan. So you put the money in, you borrow against it, and then you pay off 95%. Now you have an installment loan on your credit mix. on your credit profile. Your score will jump because it diversifies your credit mix. So in my scenario, I only had personal credit cards and it increased my score 800, 826 because I diversified my credit mix. If you already have auto loan, a mortgage, student loans, installment loans, this would be less significant, but it still can help strengthen your profile with very, very little effort. The two credit unions worth doing this at is number one, PenFed, and number two, Navy Federal. Navy Federal requires a military affiliation, which most people don't have. PenFed also does, but there's actually a back door on how you can join PenFed, and you can do that through the back door by joining a qualifying organization with just a $15 donation. It's very worth it. You become a member of one of these credit unions, and then you can do this pledge loan strategy. Again, it diversifies your credit mix and it shows then a 95% paid off installment loan. The higher the amount is, minus $10,000, the higher it is, the more attractive it looks, making it then easier to get approved for higher limits on business credit cards, as well as higher limits on any installment loans that you get in the future. Okay, now, what do you do once you cross the $100,000 of personal credit? You're not stuck, you just need to switch playbooks. You should stop applying for personal credit immediately. You just want to now start seasoning your business banking relationships, specifically at the big banks. You start building business credit bureau scores under vendor trade lines. This is one of the most underrated moves in the entire space, and it's stupid cheap if you know the right vendors. 3 vendor trade line subscriptions, 1 month for each of them. Nav Prime at $50 for 1 month. Reports to Dun & Bradstreet plus Experian Small Business. Fair Figure for just $30 a month, another subscription, and then eCredible, another subscription for about $20 a month. So for about $100 for 1 month, you just sign up for those 3, you let the statement cycle, and then it's going to report those trade lines to Dun & Bradstreet and Experian Small Business. So what that does, it gives you a business credit score. Gives you an 80 on each, it should. And so basically what this is gonna do is when you apply for business credit cards, the banks will pull from your personal credit as well as your business credit profile. And the thing is, once these subscriptions report, you can then cancel all 3, and that trade line is then going to stay on your profile for the next 2 years. When it comes to business credit cards, most of the business credit cards do not report to the business credit bureaus, which is why most people building credit on the business side make 0 progress with their D&B score. The exceptions, the Chase Business Inc. cards, Citi, FNBO, and PNC cards. Those do report. So you have to seed your business bureau profile manually with these vendor trade lines. A few more rules around the personal side that matter just as much as the building rules. Never close your oldest account. Average age of your profile is a massive factor of your score. If your first card was opened 12 years ago, you never want to close it, even if you don't use it. Drop it in a drawer, let it just sit and keep building age. You don't want to cancel that oldest card. If you were to close some of your credit cards, try to at least downgrade instead of closing whenever possible. For example, from the Chase Sapphire Reserve to the Chase Freedom Unlimited, or from the Capital One Venture X to the Capital One Venture. You keep the account age, but you lose the fees, or you decrease the fees. Best of both worlds. This isn't about being conservative with credit, it's about being strategic. The whole game is leverage. You want to spend your personal credit budget where it gives you the highest return on the business side. Most people don't actually understand how their credit score gets calculated, which is why their attempts to fix it are so random. So let me break it down properly. FICO 8 is the score that most banks pull from. It's built off 5 factors. Each factor has a different weight. Payment history is 35%, whether you pay on time. Credit utilization is 30%. How much of your available credit are you using on the personal side? Length of credit history is 15%. How old your accounts are on average. Your credit mix is 10%, whether you have a variety of account types like cards and loans, and new credit is 10%. This is for recent inquiries and just new accounts reporting. For payment history at 35% is the single biggest lever. One missed payment, you can drag your score down 60 to 110 points. So don't miss payments. Auto pay for minimum on every card. Do this, set this up so you never accidentally slip and have a late payment. For credit utilization at 30% is the second biggest lever. This is where the under 10% utilization rule comes from. The math is simple. Divide your statement balance by your credit limit. If you have a $10,000 limit and the statement closes with $1,000 on it, that is a 10% utilized card. So you want to pay that down before the statement closes, not after. That single shift moves your scores faster than anything else on the list. It is the easiest way to increase or decrease your score. For length of credit history, credit mix, and new credit makes up the remaining 35% combined. That's where the average age really matters. That's where the pledge loan specifically adds installment variety to your mix. And this is where every hard inquiry counts. 5 to 10 points, it can ding your score. So you want to be very strategic and very careful on getting too many hard inquiries in a short period of time. With hard inquiries, they carry weight on your profile for 12 months and they stay on your profile with no weight from 12 months to 24 months. After 24 months, those hard inquiries fall off your report. So once you understand the weights, your moves get strategic instead of just random. Attack the first 35% lever first. Make sure every payment for the last 12 months is super clean, on time. Then the 30% lever, which is utilization. Pay it down everywhere you can. Lower the better. Then do something like add a pledge loan to diversify your mix. Then stop applying for new credit for 6 months. That's gonna help you get approved for business credit cards. That sequence alone can move your score between 30 and 120 points in just 30 days. If you wanna watch my hour-long masterclass on business funding, then click this video right here at the top of the screen. It covers everything from A to Z on how to optimize your personal credit, what to do prior to applications, how to build the best strategic bank relationships with the right banks, and I even go through 3 different examples showing clients that I've worked with. I show what their profile looked like. I outline what specific recommendations I gave to them, and then I show the exact results that they got on 0% interest business credit card. So it's a full masterclass. It's an hour long. Click this video right here, and I'll see you there.